These are the best stocks for your portfolio. I mean it seriously. Although I don't know you, I don't know your investment strategy. I don't know if you're a dividend income investor, dividend growth investor, or if you don't really care about dividends, but more about capital gains in the long run. But if you invest in stocks, then I know which stocks are the best for you. And I know this because it's always the same category of stocks which are the best. And if you don't consider these, if you don't consider the rule, or don't know about this rule, then your investments won't be successful in the long run. I can guarantee this because it always applies. It always applies if you're not a trader or if you're not going to speculate, but if you're an investor. What I'm talking about is long-term profit growth. It's the foundation of dividend stocks cash here. It's the foundation of my investment strategy, of my experience, and it's the foundation of your investments too, or at least it should be the foundation of your investments if you want to become a successful investor. What I'm talking about long-term profit growth. And how does it look like? I can show you. It looks like this. This is long-term profit growth. And if the company has long-term profit growth quantified by earnings and cash flows, then it will be a successful investment. Then you will harvest capital gains and you will benefit from growing dividends as well. I will show you. I just clicked on the first company. It's called Rational, and this is a full chart analysis. And here you see the stock price evolution. Back in 2002, stock price was about 36 euro in this case, and today it's close to 600 euro. So from about 30, low was 27 euro. From about 30 to 600, we have a multiplication of 20 within less than 20 years, about 15 years. That's what I mean with capital gains in the long run. Here's how capital gains look like from year to year. You see that it was overall a very good investment nearly each year, with the exception of the financial crisis and 2002 .com bubble bursted. And how is it possible? Such capital gains, they are possible thanks to this. Thanks to long-term profit growth. That's the growth of the reported earnings, and that's the growth of the already cash flow. They go hand in hand, and they make the company more and more valuable with each year. And then you have also dividends, which grow nicely, except during the financial crisis, where they were cut, and they were also cut sometimes here. That's the difference between US companies and non-US companies. Non-US companies, there the dividends are not as stable as they might be if they were US companies, where dividend aristocrats, and this dogma is much more important. Then we have a lot of stocks with growing earnings. You see all these, and they are all good investments if you look at the capital gains and the dividends, if they are dividend payers, and you will always see growth. Church and White is another example. I am long Church and White. And if we take a look at stock price, it's basically the same. The stock price was a little bit above $3 in 2000. Today it's 73.83 US dollar. So a nice increase. And here you see the yearly capital gains, mostly green, rarely red in 2000 and in 2005, even during the financial crisis, positive outcome. And why is it so? It's the same answer. It's always the same answer for long-term good investments. It's long-term profit growth, growing earnings, growing cash flows, leads to growing dividends as well. If you want to have a look at the cumulated dividends, and you see here a nice upward curve with high dividends, highly rewarding experience. And from time to time, it's still stocks. There is you may have to suffer for some years, even if the earnings grow. And then the example for this is Inditex, it's a Spanish company. And there I just want to show you, I needed to search for such an example, but I wanted to give you an example where you have a company with growing profits, and nevertheless you have here some bad years. It's in 2019 the stock lost about 60%, and in the year before the stock also lost about 4%, but it won about 11% in the last months. But anyway, even if you consider this a price drop, but if you look at the long-term capital gains, then the stock still increased from lower than 4 euro to still 27 euro today in about 30 years. That's still overall nice yield, and also, or even more, if you consider growth or growing dividends. And that's investing in stocks. You might have bad years. In this case, it was because probably the stock price or the stock was a little bit overvalued. We had in 2016, before the stock started dropping, or the stock started dropping in 2018. So we had price earnings about 30 or close to 30, and now they came back to 25. So maybe the stock was a little bit overvalued. We might even see this here, that the stock was a little bit overvalued. Yes, exactly. And now the stock is fairly valued right now. It's I just wanted to give you an example, or to prepare yourself that growing earnings and cash flows don't guarantee growing capital gains each year. There are also some more objections I already encountered when I was talking with our people about this. Then they said me, hey, that's already nice, you have a nice past here, but what matters is the future. And I don't care about the past, I only care about the future. I am a very smart investor. So my answer is, there's no guarantee that the future or that the past will continue in the future, so that the earnings growth will continue like this, even if estimates or analysts estimate that they will. But there's a high probability that a company which was able in the past to increase its profit like this will be able to do the very same in the future. Because we're not playing roulette here. It's not a coincidence that in 2006 earnings were higher than in 2005, that in 2007 they were higher in 2006, that in 2008, and blah, blah, blah. You know what I mean? That's not roulette. It's not a lucky strike here. It's a professional strike. It's a company. It's a company whose products and services they can sell, and they know how to make profit. They proved it already, and probably they will continue to do so. If you invest in such stocks, and if you diversify your portfolio with just such stocks, then most probably some of these stocks will disappoint you, because their earnings strike will finish because of any event, I don't know. But for the majority of the stocks, the earnings strike will continue like this. And these stocks will overcompensate your fails greatly. That's one point. Another point people ask me is, why do we need to look for growing profits, growing earnings? I'm only interested in dividend stocks and dividends. So why stable earnings should be enough? And I think it's not enough to invest in the companies with no earnings growth, because In theory, yes, because they will generate always the same profits. This means that they have to invest some money for sure, but then the rest of the money can be paid out as dividends, which means that the valuation of the market would be very low. The stock would trade with low multiples, with low price earnings, for example, because there is no growth. Why should investors pay much for such a stock? And in turn, this would mean that the dividends or the dividend yield would be rather high because the price of this stock is rather low. But in the real economy, where there is competition, companies without any growth won't probably be successful for a long time or even exist for a long time, because other companies will be more successful than them, their competitors, and the competitors will eat them. They will steal from their market share, and if the market grows, even if the market grows, stagnating earnings means that the market share of such a company will decrease, and finally they will disappear. So the company needs to increase its earnings, it needs to increase its revenues, and it needs to defend its market share or even to gain more market share. Otherwise, the company won't be successful and your investment won't be successful. And another thing people told me when looking at such stocks was, oh, they are already so expensive. They trade at high price earnings, for example. And yeah, it's true. Companies like these, they trade with higher multiples, but they are worth these multiples. In general, they can be overvalued, yeah, for sure. And on dividend stocks cash, we have also fair value calculations. They can be overvalued, but in general, it's legitimate that they trade at higher multiples because they grow. If you look at stocks which do not grow, which are in crisis mode, they trade at lower multiples. But does this help you in any way to achieve future capital gains or growing dividends? No, it doesn't help you in any way at all. Maybe you will have luck and invest in a turnaround candidate, and the turnaround really will be successful. Then you are a lucky investor. But you can't make this invest like this as a strategy. Just buy cheap stocks and then hope that they will find their turnaround. It's not good. It's not a good idea, because mostly it will fail. So finally, I told you that I know which stocks are the best for your portfolio, and you know now why, because it's always the same. The solid foundation for any investor's portfolio is long-term profit growth. You now know how long-term profit growth looks like, and I wish you to consider this, because then you will be successful. That was Thorsten from Dividend Stocks Cash. Thanks for watching. Bye bye.